Welcome to the GetMoneyRich podcast, where we delve into the strategies and stories behind some of the most successful investments in history. I'm your host, Money, and I am the blogger behind GetMoneyRich.com. Today, we are going to explore an iconic investment by one of the greatest investors of all time, Warren Buffett, and what we as retail investors can learn from the experiences of Warren Buffett's investments. Today's topic is Buffett's legendary investment in Coca-Cola. Let's learn more from it. It was 1988, just a year after the stock market crash of 1987, also known as the Black Monday. Warren Buffett, the chairman of Berkshire Hathaway, made a bold move by investing about 1 billion in shares of Coca-Cola, a company whose stock was still recovering from the 1987 crash. This investment would become one of the most successful and enduring in Buffett's career. But why did he choose Coca-Cola? And what can we retail investors can learn from his decision? Let's break it down. One of the first lessons we can learn from Buffett's Coca-Cola investment is the importance of recognizing opportunities in market fall. After the 1987 crash, many stocks were undervalued, including Coca-Cola. Buffett saw beyond the immediate market panic and earmarked Coca-Cola as one company that has strong fundamentals and dominant market position, and still its price is undervalued. This attracted Warren Buffett towards Coca-Cola. Did you know that in 1987 the stock market crash, also known as the Black Monday, saw the Dow Jones Industrial Average drop by 22.6% in a single day? This remains one of the largest single day percentage drop in history. It created a buying opportunity for those who could look beyond the market panic. For we retail investors, the takeaway here is not to be swayed by the short term market volatility. Instead, look for quality companies with robust fundamentals that are temporarily undervalued. These periods can present golden opportunities to buy into great companies at attractive prices, undervalued prices. Buffett often talks about investing in companies with a moat. A moat refers to a company's ability to maintain competitive advantage over its rivals, to protect its long-term profits and market share. A company which doesn't have moat will not be able to protect itself from the rising competition. Coca-Cola's moat includes its global recognized brand, extensive distribution network, and loyal customer base. These were the Coca-Cola's moat. Coca-Cola is not just a drink, it's a brand with a history. The iconic Coca-Cola bottle shape was introduced way back in 1915 and was designed to be recognizable even in the dark. It is a symbol of Coca-Cola's powerful brand identity. For we retail investors, identifying companies with a strong moat can be crucial for long-term investing. Look for companies with a strong brand, customer loyalty, and unique product or services that competitors will find it hard to replicate. These companies are more likely to withstand market pressures and grow over time. Even in bad times, such companies are sure to survive. Another critical lesson from Buffett's Coca-Cola investment is the power of long-term perspective. Buffett's favorite holding period is forever, and his investment in Coca-Cola exemplifies this. Despite various market fluctuations and challenges, Buffett held on to his Coca-Cola shares, reaping substantial returns and consistent dividends over the decades. Buffett famously said, Buffett famously said, our favorite holding period is forever. This long-term perspective has been key to his success, allowing his investments to compound over time and yield substantial returns. Retail investors should adopt a similar mindset. Focus on the long-term potential of your investments rather than being distracted by short-term market noise. Patience is often rewarded in share market, as quality companies tend to grow their earnings and dividends over time. Coca-Cola is known for its consistent dividend payouts, which has significantly contributed to the overall returns of Buffett's investment. Companies that regularly pay and increase dividends demonstrate financial health and shareholder friendly practices. Coca-Cola has been paying dividends since 1920 and has increased its dividend payout every year for more than 50 years, making it a dividend king. This kind of track record speaks volumes about the company's financial stability. For we retail investors, seeking out dividend paying stocks can be a smart strategy. These stocks not only provide regular income but also often indicate a company's strong financial position and commitment to returning value to their shareholders. Before investing in Coca-Cola, Buffett thoroughly understood the business, its competitive advantages, and its growth prospects. So Buffett did not invest in Coca-Cola blindly. He knew what he was doing. This deep knowledge gave him the confidence to invest heavily and hold on to the stock for the long term. Buffett's investment in Coca-Cola was also personal. He has been known to enjoy drinking cherry coke, which is a testament to his belief in the product he invested in. His love for the drink even led to cherry coke cans featuring his face in China. Retail investors should take the time to understand the business they invest in. Do not buy the stocks blindly. Try to understand who runs the business, what are the products. Uh, all these things are necessary before we can go ahead and buy stocks. So, how to understand the business? This includes analyzing the company's financial statements, understanding its industry, and evaluating its management team. A well informed investment decision is more likely to succeed. So, what is the takeaway from the lesson that we have uh, heard about Warren Buffett's investment in Coca Cola? To recap, here are the few key lessons retail investors can learn from Warren Buffett's investment in Coca Cola. Number one, Recognize opportunities in market downturns. Look for quality companies that are temporarily undervalued. When there is a market fall, if the prices of even quality companies fall, that is the time where we should buy quality stocks. Number two, invest in companies with a moat. Focus on businesses with strong competitive advantage. These are these are companies which has very little competition from its peers. Look for these companies, buy their stocks. Adopt a long-term perspective. Be patient and focus on the long-term growth potential. Do not buy stocks today for selling them after 1 year. When you are buying a stock of a quality companies, go with the perspective that you are going to hold it for next 5, 6, 10 years. Consider number four, consider dividend growth. Invest in companies with a track record of paying increasing dividends. Dividend is not just cash in, it is also a very strong signal that the company is financially healthy. Number five, understand the business. Make well informed investment decisions by thoroughly researching the companies you are investing in. Do not buy stocks just because somebody else has given you this tip that this stock is good. Okay, that stock can be good, but you do your own research. Try to understand what the company does, what is its business, what are its products, who are its customers in the last few years, how well it has done its business. So these informations are must before we can buy a stock. So by applying these principles, retail investors can build a resilient and profitable investment portfolio. So thank you for tuning in to Get Money Rich podcast. I hope you found today's episode informative and inspiring. Please don't forget to subscribe to my YouTube channel for more insights and successful investing strategies. Until next time, happy investing.